Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So today, we're plunging right into the numbers from, well, one of the true heavyweights in tech and infrastructure. We're looking at their latest financial update.
That's right. It's Q4 for their 2025 fiscal year and their first look at what 2026 is shaping up to be.
And our mission here for you is to really understand how this explosion in AI growth is doing more than just boosting sales. It feels like it's fundamentally warping their whole business model.
It absolutely is. You know, they're moving from just selling components to delivering entire systems.
Exactly. And that shift, well, it's right there in the headline numbers, isn't it?
Oh, it's impossible to miss. I mean, the scale is just redefining things. Fiscal year 2025 as a whole was a record. Consolidated revenue hit, what, $64 billion?
Up 24%.
Right. But, you know, if you look under the hood, the real engine here is AI. AI semiconductors alone brought in $20 billion.
Which is a 65% jump year over year. I mean, that's just staggering.
It is. And at the same time, their software business is just humming along.
Yeah, that infrastructure software segment, $27 billion, up 26%. So you have this powerful duality, booming AI hardware on one side and this really robust enterprise software on the other.
It's a unique position. But you use that word warping, and I think that's perfect. Because when you zoom in on the most recent quarter, that's when things really start to bend.
Okay, let's do that. Q4 of 25. It feels like the speed just keeps cranking up.
It does.
Total revenue was a record $18 billion for the quarter. But the real story is inside that semiconductor number, $11.1 billion.
And inside that number, you have the AI chip revenue, which was $6.5 billion in just Q4.
I mean, that's a 74% year-over-year acceleration for just that one segment.
And that's the key, right? This isn't just, steady growth. It's a step function change. It's a signal that they're moving away from just selling chips to forging these incredibly deep strategic partnerships.
So if that was Q4, what does Q1 of 26 look like? Where's this momentum heading?
Well, guiding consolidated revenue up to $19.1 billion.
Okay, so a sequential jump.
A nice jump, yeah. But listen to the AI semiconductor forecast. They're projecting $8.2 billion for Q1.
$8.2 billion.
Which means the AI segment is on track to literally double year over year. That kind of growth is, well, it's almost unheard of. It requires a massive supply chain effort.
And this brings us to the metric that I think just defines their entire competitive position right now, the backlog.
The backlog.
Yeah, we're not just talking about sales that happened last quarter. We're talking about orders that are secured, they're stamped, probably paid for.
Absolutely. The total AI order backlog, and this is for everything, the custom processors, the switches, the optics, it's now over $73 billion.
Just think about that number for a second. $73 billion.
And that's revenue that they expect to deliver over the next, say, 18 months. To put in context, their entire company's consolidated backlog is $162 billion.
So it's almost half.
Just about half of the company's future is riding on this one technology trend.
Wow.
And this isn't just a number, it's strategic. It massively increases the switching cost for their customers. When you've committed that much money to custom parts with a year-long lead time, you're locked in.
You're not going anywhere.
You're not. And they think they can absorb even more orders into this backlog over the next year and a half. This is how you build a competitive moat out of silicon.
So let's talk about that silicon, the actual products building that moat, the XPUs. We know this custom accelerator business more than doubled. For anyone listening, can you just quickly frame what an XPU actually is?
Sure. XPU is just their name for a custom accelerator. Think of it as a processor that's designed from the ground up, for one thing. AI workloads. It's not a general-purpose chip.
It's a specialist.
A total specialist. And what's fascinating is the business model it enables. Their customers are using them for two really high-value things. First, the incredibly expensive job of training these huge, large language models.
Coding the foundation.
Exactly. And second, for inferencing. That's when they actually monetize the models through APIs and apps that we all use. It supports the whole AI value chain.
And the customer commitments. they're just on another level. I mean, they just got a fifth XPU customer in Q4, a billion-dollar order for late 2026.
Which is incredible on its own.
Right. But then you look at their fourth customer, Anthropic, they placed a $10 billion order in Q3, and then in Q4 they added another $11 billion.
That's $21 billion
Right.
from one customer for delivery in late 2026.
It's the ultimate signal.
It is. And it gets to that crucial shift you mentioned at the start, this pivot to system sales. For a customer like Anthropic, they're not just getting a box of chips anymore.
Right.
They are getting a complete pre-configured system, a full rack. It has the XPUs, the special memory, the networking gear, power supplies, everything.
So they've gone from being a chip vendor to being a system integrator. They're delivering a ready-to-run AI supercomputer.
That's the business now.
Which brings up the question we hear all the time. Why don't these huge cloud companies, with all their money and engineers, just build all this stuff themselves?
It's the natural question, and it's one we have to address. The company's counter-argument is actually pretty compelling. First, they say that building these XPUs is an incredibly complex, multi-year commitment.
Yeah.
It's really hard to do that and run your core business.
And second,
This is crucial, they argue their custom hardware just offers dramatically better performance than a general-purpose GPU in certain key areas.
can you get more specific? Like what areas?
Yeah, so a key one they talk about is something called sparse core functions. In simple terms, it's the chip's ability to efficiently handle models where a lot of the data is just zero.
Which is common in these massive language models, right?
It's inherent to them.
Yeah.
So having hardware that's built to handle that sparsity, it just drastically improves efficiency for both training and things like reasoning and decoding. You just can't get that with an off-the-shelf chip.
That makes a lot of sense. And that specialization probably explains why customization leads to more sales for them.
Yeah.
A customer can't just use one generic XPU for training and then decoding and then reasoning.
Exactly. That's the key. They rarely sell just one type of XPU. A customer might need one version with tons of memory bandwidth for training and a completely different one that's optimized for low latency decoding.
So the hardware has to be diverse.
Right, and that diversity, that need for tailored designs, it just dramatically increases the total dollar value of the whole deal.
And we're seeing this play out elsewhere too, like with Google's TPUs. They built those for their own models, like Gemini.
One of the earliest custom chips, yeah.
But now they're extending them externally. Other AI players, like Apple and Cohere, are using Google's custom chips through their cloud. It shows these systems become so powerful they can be resold as a service.
It's a huge market broadening effect. The system itself becomes the product.
Okay, so if they're delivering these full racks, we have to talk about the plumbing. You can't run these massive clusters without insane connectivity.
Right, the AI networking side.
Right.
And demand there is also just ratcheting up. The backlog just for networking components is over $10 billion.
$10 billion.
Yeah, which tells you that customers are buying the infrastructure, the switches, the optics, way before the XPUs are even ready to be plugged in.
Yeah.
You have to lay the pipes first.
And some of this hardware is just, it's mind-bogglingly fast. They're seeing record orders for this Tomahawk 6 switch. It runs at 102 terabits per second. What's the significance of that?
Well, the Tomahawk 6 is basically the only switch on the market right now that can handle the fire hose of data you need to connect the latest XPU and GPU clusters.
So older switches just can't keep up.
They hit a wall. If you're building a multi-billion-dollar AI factory, you can't have a network bottleneck. So this switch becomes the only real option. It's the critical link.
And it's not just the switches. We're seeing strong orders for all the little bits and pieces too, right? The DSPs, the lasers, the PCI Express switches, the whole ecosystem.
It's the whole ecosystem.
Right.
And if we break down that $73 billion AI backlog, roughly $20 billion of it is just for these networking and connectivity parts.
Wow. So it's not a trivial part of the business.
It's a huge business on its own. The plumbing is literally worth billions.
Okay, let's talk about the financial side of this. If they're selling full systems, they must be including a lot of expensive parts from other companies like HBM memory. What does that do to margins?
That's a great question, and it's one investors are watching closely. So that AI revenue, especially from the system sales, it does have a slightly lower gross margin compared to the company's average.
And that's because they're just passing through the cost of that memory or other parts.
Exactly. They're passing through costs of things they don't make.
Huh.
However, and this is the important part, the sheer volume and the insane growth rate give them huge operating leverage.
So, okay, Even if the margin percentage goes down a little, the massive jump in sales means the operating margin in pure dollars goes way, way up.
You got it. The velocity makes up for the slight dip in the percentage. It's all about generating way more profit dollars. The scale gives them the leverage,
And to support that scale, they have to be investing in their own supply chain. Building these things requires something called advanced packaging.
which is a huge industry bottleneck right now. Advanced packaging is this really complex process of stacking multiple different chips together into one package. It's incredibly difficult.
So what are they doing about it?
To reduce their risk, they're actually building a huge new facility in Singapore. The idea is to partially insource this critical step.
And is that about cost? Or something else?
It's not really about cost. The main driver here is supply chain security. It's about ensuring they can actually deliver on those massive backlog commitments on time. By controlling this step, they're less reliant on a very strained third-party system.
So they're solving the packaging problem before it becomes a crisis.
Precisely. And they mentioned that the supply of the core silicon itself, the 2-nanometer and 3-nanometer chips from TSMC, that's not currently constrained. It's all about the packaging.
Okay, let's shift gears for a second to the rest of the business. That infrastructure software segment, it's still a massive, solid foundation.
It absolutely is. Revenue there was $6.9 billion in Q4, and that's with the big VMware integration now complete.
And the backlog there is also huge.
It is. The software backlog is also $73 billion, matching the AI hardware backlog dollar for dollar, and they're forecasting low double-digit growth for software next year, mostly driven by their VMware Cloud Foundation platform.
What about the non-AI chip business, the traditional stuff? Is it feeling the pull from all this AI spending? Yeah.
It's resilient, but you can definitely see the pressure. Non-AI chip revenue was about $4.6 billion in Q4, and it's guided to be stable at around $4.1 billion in Q1.
Okay.
Broadband showed a nice recovery, which is good.
Yeah.
But enterprise spending, it's still showing very limited signs of life.
So the theory is that AI is just sucking up all the oxygen in the room.
It's a pretty strong theory. It seems like most of the available IT budget right now is going towards AI build-outs, not general upgrades. So the traditional segment is stable, but it's not really growing.
And all of this is generating just a ton of cash.
An incredible amount. Free cash flow for the year was almost $27 billion, and they're returning a lot of it. The dividend was just raised 10%. That's the 15th year in a row they've increased it.
It's the definition of financial strength. So to wrap this all up, if we synthesize everything, what's the one key takeaway for you?
For me, the key takeaway is this fundamental transformation. They are moving beyond selling individual chips. They are now in the business of delivering complete, bespoke AI systems, full racks, to the biggest and most important players in tech.
It changes the whole relationship.
It gives them so much deeper control over the core infrastructure of the AI economy. They are building the foundation, and that $73 billion backlog, that's the proof.
Okay, let's leave you with a final thought to mull over. Given this company's critical role in both custom AI silicon and the high-speed networking that connects it, how long can the non-AI part of the business really remain stable? It seems inevitable that the AI trend will eventually force a complete re-architecture of all data centers. When does that high-efficiency AI model just become the standard for everything, forcing a huge overhaul of that stagnant traditional segment? Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.